If you pull up the stock chart right now for Taiwan Semiconductor Manufacturing Company, that's TSM, you are going to see a dashboard that is practically short-circuiting.
Oh, absolutely. It's flashing every signal all at once.
Right, because on one hand, you have this massive, almost historic bullish wave pushing the stock to just incredible highs.
Mm.
We're talking about overwhelming demand here, and Wall Street analysts are aggressively calling it a strong buy.
Yeah, they're loving it right now.
But then, you look at the technical indicators, and some of them are flashing these bright red warning signs. Some metrics suggest the stock is, well, severely and dangerously overvalued.
Like it's essentially waiting to spring a trap on the very next person who buys in.
Exactly. So for you, the listener, trying to make sense of this market, what is the real story here? Is this a runaway train you need to jump on, or are you, walking directly into a buzzsaw?
It's honestly one of the most complex setups we've seen in a really long time. I mean, you're watching a real-time collision between undeniable fundamental business dominance and the very real unforgiving laws of market physics.
Yeah, unprecedented demand is quite literally crashing into technical exhaustion. So welcome to this deep dive into the latest data on TSM.
Glad to be here.
Today, we're going to examine their preliminary Q1 2026 financials and dissect the technical order flows to see who is actually driving this price action.
We're also going to weigh the explosive AI bull case against some very massive structural risks.
Right, exactly. And before we unpack all this data, I need to ask you to please like this video, subscribe to our YouTube channel, and leave your feedback in the comments. I mean, commenting is absolutely compulsory if you want us to keep making these deep dives.
Yeah, we read all of them. It really helps the channel.
It really does. And just to be clear up front, while we are going deep into the data today, this is purely an analysis of the provided sources. This is not financial advice.
Right. We're just synthesizing the data so you can understand the mechanics at play rather than, just reacting to all the market noise.
Okay, so let's ground this in reality. As of Friday, April 10th, 2026, TSM closed at $370.60.
It's a massive number.
Huge. And the narrative driving this price is the unprecedented demand for AI high-performance computing chips, the HPCs.
Right. These are the massive orders coming from giants like NVIDIA and Apple.
Yeah, and people love to say AI is the new digital gold rush, right?
Yeah.
And that TSM is selling the picks and shovels.
I hear that analogy all the time.
But honestly, it doesn't capture the reality of their leverage. Okay, let's unpack this. If AI is the new digital gold rush, TSMC isn't just selling the picks and shovels. They own the only hardware store in town, and they're dictating the prices.
Oh, that is exactly it. That hardware store analogy hits the nail on the head because it explains their absolute pricing power.
Right.
When you look at their preliminary Q1 2026 income statement, the numbers are just a direct reflection of that monopoly. I mean, they are reporting revenue of 1.13 trillion new Taiwan dollars.
Which is just staggering.
It really is. For our U.S. listeners, that translates to roughly 35.7 billion U.S. dollars. And that's just in a single quarter.
Wow, which is a 35.1% year-on-year increase. But honestly, any company can grow revenue if the market is hot enough.
Sure, rising tide lifts all boats and all that.
Exactly. What actually stopped me in my tracks when I was reading through the sources were the margins.
Oh, yeah. The margins are wild.
They really are.
Yeah.
They are estimating a gross margin of 63 to 65% and an operating margin of 54 to 56%. I want to make sure everyone listening grasps how bizarre that is for a manufacturing company.
Right, because usually manufacturing means heavy costs.
Exactly. Software companies get 60% margins because making a second copy of a software program costs absolutely nothing.
It's just copy and paste.
Right. But TSM is manufacturing the most complex physical objects in human history. They are literally manipulating atoms on silicon wafers, and they are pulling software-level margins.
And that anomaly, it exists entirely because of the technological moat they've built. Like, they hold about 70% of the global foundry market.
Which is basically a monopoly.
It is. But more importantly, they have an outright monopoly on the advanced 2-nanometer and 3-nanometer nodes required for AI.
Right, the stuff that actually powers the cutting edge.
Exactly. Manufacturing at that microscopic level requires these massive EUV lithography machines. It takes a level of precision that their competitors simply haven't mastered yet.
So nobody else can even compete.
Nope. If NVIDIA or Apple wants the most efficient, powerful chips for their data centers or, their phones, they literally cannot shop around. TSM names the price.
And that leverage flows straight down to the bottom line. It's giving them a trailing 12-month earnings per share of $10.45.
Which is incredibly strong.
Yeah, and that financial foundation, it shows up on the balance sheet, too. I mean, this is a company with a market cap sitting around $1.92 trillion.
Massive.
And looking back at their full 2025 data, they generated $34.59 billion in free cash flow. But the metric that really highlights their financial fortress, for me at least, is their debt-to-equity ratio.
Right, the 19.57 figure.
Exactly, 19.57. For context, for those listening, that means for every dollar of equity they have, they carry roughly 20 cents of debt.
Which is practically nothing in their industry.
Right. In a highly capital-intensive industry where you have to constantly borrow to build new factories, that is an incredibly conservative, highly manageable debt load.
It gives them just a massive cushion. I mean, they aren't going to be crippled by interest payments anytime soon, that's for sure.
So the house is built on a solid foundation, which explains why insiders are buying right now.
Yeah, we saw some very interesting insider action in the source material.
We did. We have records showing net buying from directors and officers in March 2026. For example, Director Ursula Burns purchased 1,000 ADS shares at around $322 apiece.
And just to clarify for everyone, ADS stands for American Depository Shares.
Right, good point.
Yeah, it's basically the mechanism that allows U.S. investors to easily buy stock in a foreign company like TSM.
So an insider is dropping serious money at $322, but if we look at the actual trading momentum today, the stock up at $370.
The mechanics of the market start to look incredibly precarious for new buyers.
Right. Are retail traders getting trapped here?
They absolutely could be. I mean, if you look at the technical setup, the stock is in a strong buy position. It's showing bullish momentum above all major simple moving averages.
And what's the immediate support looking like?
The immediate support is sitting right around $370, and there's a major support level further down at $350.
Okay, and overhead?
Resistance sits right overhead at the 52-week high of $390.21.
Which is just a staggering climb when you realize the 52-week low was down at $145.84.
Oh, it's been a massive run.
Yeah.
And the MACD indicator is currently showing a bullish crossover.
The MACD?
Yeah, the moving average divergence. It basically compares short-term momentum to long-term momentum. When that short-term trend line crosses above the long-term one, it signals that buying pressure is really accelerating.
Okay, but knowing retail traders might be walking into a momentum trap makes me look at the actual price tag a bit closer, because there is a glaring warning sign on the dashboard right next to that bullish MACD.
You're talking about the RSI.
I am. The 14-day relative strength index is sitting right between 70 and 75.9.
And that is a critical detail. The RSI measures the speed and magnitude of recent price changes, basically to evaluate if a stock is overvalued or undervalued in the immediate term.
And anything over 70 is officially overbought territory, right?
Exactly. It means the buying velocity has been so intense that buyers have likely exhausted themselves.
So a pullback is coming.
A consolidation or a pullback is highly probable at this point because the rubber band has just been stretched as far as it can go.
Here's where it gets really interesting, though. With options order flow showing a 54.1% bullish bias on calls and overall market sentiment sitting at a whopping 80% bullish.
Everyone's convinced it's going to the moon.
Right. Everyone thinks it's going straight to $500. Isn't this exactly the kind of setup where retail traders get trapped buying at the absolute top just before a cool down?
What's fascinating here is how textbook this momentum trap really is. The fundamentals of TSM are spectacular, yes, but market mechanics dictate that a stock just cannot go straight up forever without breathing.
It has to correct.
Right. And overbought momentum often precedes short-term weakness or consolidation. It creates a highly volatile trap for latecomers, even in a fundamentally strong company.
Because institutions see that RSI of 75, and they start selling into that strength to lock in their gains.
Exactly. You could be entirely correct that TSM will be a powerhouse for the next 10 years. But if you buy in at peak exhaustion, you could easily suffer a painful 10 to 15% drawdown over the next month as the stock cools off.
Which brings up a fascinating conflict in the analyst community right now regarding TSM's actual valuation. Is TSM actually cheap, or is it secretly a value trap?
That is the great valuation debate right now.
Let's look at the undervalued argument first. Right now, TSM is trading at 24 times its forward earnings.
Which is the foundation of the bull case.
Yeah, because when you compare that to the broader semiconductor industry average, which is sitting way up at 41.3 times forward earnings, TSM looks like an absolute bargain.
It really does imply the stock could almost double just to be in line with its peers.
But then we have the overvalued argument, the other side of the coin.
Right, and that relies on historical data rather than future projections. If we look at the Guru Focus data provided in the sources, they calculate an intrinsic worth called the GF value.
And what does that metric actually look at?
It analyzes historical trading multiples, past growth rates, and baseline business performance estimates, basically historical norms.
And the GF value places TSM's true worth at $280.17.
Correct. Which means, at over $370 right now, it could be seen as 32.3% overvalued.
That is a massive discrepancy. 24 times forward earnings tells you it's a bargain. The historical GF value tells you it's a bubble. How do we synthesize these conflicting signals?
Well, it really comes down to a debate between the explosive future versus historical cyclicality. The forward PE is looking at the explosive AI-driven future.
It assumes the demand we're seeing right now is just a permanent new baseline.
Exactly. While the historical GF value is anchored in the past, it's essentially arguing that no hardware manufacturer, no matter how dominant, can sustain these margins forever without supply eventually catching up.
Because historically, semiconductors are a notoriously boom and bust cyclical industry.
Precisely. So the real question is, do you believe AI has permanently broken that historical semiconductor cycle? Or will the historical mean eventually pull this stock back down?
And that question leads us right into the downside risks. Relying purely on future AI growth is great, but we have to look at what could derail this. So what does this all mean when we look at the broader landscape?
We have to outline the bull case versus the bear case here.
Let's briefly reiterate the bull case for growth. It's basically their bullish dominance, right?
Yeah, 70% global foundry market share and an absolute monopoly on the advanced 2-nanometer and 3-nanometer nodes required for AI.
Their unique tech leadership gives them unmatched pricing power, we know that. But let's look at the worst-case continuation lower. I challenge you to outline the bear case right now. What are the actual risks?
The vulnerabilities are profound, honestly. I'd say there are 3 major hurdles. The first and most heavily weighted risk in every institutional model is geopolitics.
Because of Taiwan?
Exactly. The concentration of production in Taiwan remains a massive systemic risk hanging over the entire stock. Any severe escalation there, and the global supply chain basically halts.
It's the ultimate single point of failure. You just can't diversify away from that if you own the stock. What's the second risk?
The second major risk is the potential for a margin crush.
Yeah.
We spent all that time marveling at their 65% gross margins, right?
Yeah, the software level margins.
Well, maintaining that edge requires an unbelievable amount of capital. TSM is spending an astronomical $52 billion to $56 billion on CapEx in 2026 alone.
Wait, $56 billion in a single year?
In a single 12-month period, yes.
Just to build factories and buy extreme ultraviolet lithography machines.
That is just an unbelievable amount of money.
It is. And this heavy spending could seriously weigh on near-term margins. Pushing down into sub-nanometer architecture is not cheap.
And that ties directly into the third risk, right? The expansion costs. Exactly. Attempting to mitigate that first geopolitical risk by building fabs in the U.S., like in Arizona and in Japan, is proving far more expensive than operating in Taiwan.
Because the entire ecosystem in Taiwan has been optimized over decades. You have suppliers and trained engineers all in a 50-mile radius.
Right. And when you try to replicate that in the U.S., you are dealing with fragmented supply chains, much higher labor costs, and complex regulations.
So they're basically spending tens of billions to build factories that will be inherently less profitable just to buy geopolitical insurance.
That's a great way to put it. It's a strategic necessity, but a massive financial headwind.
Okay, so we have these massive long-term risks. But bringing the conversation back to the immediate future, Wall Street is overwhelmingly focused on 2026.
They really are. Wall Street is just looking at the immediate growth.
Let's talk about the outlook. What are the analyst ratings saying?
Right now, 85% of analysts maintain a strong buy rating.
Wow, 85%.
Yeah, and the average price target is sitting between $392 and $437.87.
With some targets even higher.
Oh, yeah. Bank of America is setting a high watermark of $500 a share. Long term, they project a massive 30% annual revenue growth.
But we don't even have to wait long to see how this plays out. The immediate focal point, the short-term catalyst, is dropping very soon. Full Q1 2026 earnings are dropping on Thursday, April 16th.
Which is going to be a massive day for the stock.
Analysts project the stock to trade between $390 and $410 in the coming weeks. But that is a big if. That only happens if earnings meet or exceed these sky-high expectations.
And with the RSI flashing overbought, perfection is already priced in. If they miss their revenue target by even a fraction, the pullback could be incredibly sharp.
So, to summarize our journey today for everyone listening, TSM has undeniable financial dominance and massive AI tailwinds.
Absolutely undisputed.
But retail traders must navigate overbought technicals, massive 2026 CapEx spending, and lingering geopolitical shadows.
It requires balancing the reality of long-term dominance against the mechanics of short-term volatility.
I want to leave the listener with a final thought to ponder, something that really sums up this tension.
Okay, think about this. TSM holds 70% of the world's most critical technological manufacturing market. But they are trying to move that manufacturing to the US and Japan, a move that is incredibly inherently expensive.
Right.
So if their attempt to solve their biggest geographical risk ends up destroying their legendary profit margins, are you buying a monopoly or are you buying the cost of rebuilding one from scratch?
Wow. That is the $56 billion question right there. Thank you so much for joining us on this deep dive into TSM.
It was a great discussion.
It really was. And to you listening, before you go, please remember one last time to subscribe and comment on the YouTube video with your take on TSM. Are you buying the AI structural shift, or are you staying far away from an overbought chart? Let us know, and we will see you next time.